Good morning. Today we'll be covering three important parts in the video today. The first is a concept of stock and flow. Second is final goods and intermediate goods. And third is factor payments and transfer payments. So we start with the first portion, the concept of stock and flow. Now, stock concept means anything which is studied at a particular point of time. This is very important. Any concept or any variable which is studied at a particular point of time is called as a stock concept. For example, if there is a bucket which is full of water, it will be a stock concept because we are not adding anything to it. There is no change in it. It is just one bucket of water. So it will be taken as the stock concept. It does not have time dimension. That means there is nothing happening over a period of time. It is at that particular point of time. How much do you have? For example, if I ask you how much money do you have just now in your pocket? So you say I have got 10 rupees. So 10 rupees is a stock concept. The main examples for this kind of concept are national wealth and national output. On the other hand, we talk of a flow variable. Flow variables are variables which are studied over a period of time. So, suppose you put a bucket and you open the tap and slowly the water is filling. So, you will be able to assess how much water is there over a certain period of time. And this period of time will be taken under flow concept. So, it has time dimension because it is measured over a certain duration of time. Examples for this will be national income because national income is studied over the period of one financial year. The goods and services which are produced over the period of one financial year will be taken under national income. Similarly, capital formation also takes place over a certain time duration. So, stock is a concept which happens over a particular point of time, whereas flow is a concept which happens over a period of time. Now we come to the second concept of final goods and intermediate goods. The final goods are goods which are used for final consumption or current consumption. That means suppose you buy a television and you are a consumer, you have bought a television and you are using it. So it is final or current consumption. Intermediate goods are goods which are used for further production. For example, if there's a company which is producing screws and nuts and bolts, these nuts and bolts will be used for something else. For example, the nuts will be fitted in a car or in some kind of machinery. So those things will be taken as intermediate goods because you can't directly consume a nut or a bolt. It will be a part of something else which will be made as your final good. Okay. So final goods are used for final consumption. Intermediate goods are used for production which will take place further. Example over here is coal used by household. If you are using coal for a fireplace, it is a final consumption. But coal used by a factory in the production of something else will be taken as intermediate good. The third point is it is always out of production boundary. That means it will never be there in a production process again. It will never be used for any kind of production. So anything, suppose you buy a notebook, it will be for final good because you're writing it and you will just use it for your own good. It will never go into the production process again. Intermediate good. It has a derived demand. Derived demand means when you demand a good to produce or get something else, then it is called a derived demand. For example, you need petrol. Why do you need petrol? To run your car. So the demand is for the car to take you to a place. But for the car to run, you need petrol. So petrol will be a derived demand. So similarly, all intermediate goods will fall under derived demand. And the last point is very important. Final goods and services are always included in national income, whereas intermediate goods are not included in national income because they are going to be used in production of a final good. And many times you are double adding the value, and hence it is not included in national income. So I hope this is clear. What are final goods and intermediate goods? The third thing that we have is called as factor payments and transfer payments. Factor payments and transfer payments. So factor payment, what is a factor payment? Something which is paid for production of something. Okay, so you are paying the various factors of production for the work that is being done. So there is some kind of output in this case. Transfer payment is something you just receive without doing any work or without doing any kind of production. For example, factor payment will be, suppose you take a land on for some production purposes, so you pay rent. Similarly, if you are employing labor, you get wages. If you have borrowed some capital from someone, you have to pay a rate of interest. If you are an entrepreneur, you will earn certain profits. So all this is there because some kind of production activity has taken place. On the other hand, when we talk about transfer payment, we talk about donation. There is an organization which helps poor people, so you donate money. You are not, the organization is not actually, it's just distributing the money. Or a gift. It's your birthday, you get a gift. For that, you have not done any work. It is just something which you are getting. So if you are getting a gift when the Prime Minister travels abroad and he gets a gift. So that is a transfer payment. Scholarship. For any kind of studies that you want to do, you take a scholarship. So this is also taken as a transfer payment. Now, under factor payment, you have, you can estimate that this much of production has taken place. And because of this production, it is worth this much. This is the cost of raw materials. This is the cost of rent. This is the cost of wages, interest, everything. And all that can be easily assessed from the goods which have been produced. This is not there in case of transfer payment because you are not producing any goods and services. Then it is bilateral. Now, what do you mean by bilateral? It means something where there's a give and take. What are you giving? Your services for the production of goods and services. What are you taking? The factor income which is coming to you. So it is bilateral. And transfer payments are unilateral. That means there's a one-way movement of the money. You are getting a scholarship. You are getting a gift. You are getting a donation. What are you giving in return? Nothing. So it is a unilateral transfer. Factor payments are included in national income. Why are they included? Because they are leading to some kind of productive work. And here, when we talk about transfer payments, they are not included in national income because you are not producing any goods or services. Okay, so I hope this was clear. Thank you.